Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pushing higher this morning after the S&P 500 closed out yet another record high. And that marks 6 consecutive days of new records. Investors are closely watching a number of earnings this morning, as well as U.S.-China trade talks taking place in Stockholm. Plus, the Federal Reserve kept kicking off its two-day meeting in Washington today. Economists widely expect the central bank to keep those interest rates on hold despite the Trump administration's calls for lower rates. And an $85 billion deal in the rail sector. Union Pacific agreeing to acquire Norfolk Southern in a cash and stock transaction valued at $85 billion. It forms a transcontinental rail giant and what stands to be the industry's largest deal ever. The tie-up poised to transform the North American rail market, marrying Union Pacific's network across the western U.S. with Norfolk's East Coast routes. The deal raises competitive pressure on rivals, including CSX and Berkshire Hathaway's BNSF, to potentially pursue deals of their own to keep pace. Well, 4 people, including a Blackstone executive and a New York City police officer, were killed Monday evening by a lone shooter in Midtown Manhattan. Blackstone disclosed Tuesday that executive Wesley LePatner was killed in that shooting. In an emailed statement obtained by Bloomberg, the company wrote, quote, "Words cannot express the devastation we feel. She embodied the best of Blackstone. She was CEO of the Blackstone Real Estate Income Trust." The shooting took place at 345 Park Avenue during rush hour around 6:30 p.m. The building's major tenants include Blackstone, KPMG, and the NFL. The gunman opening fire in the lobby before heading to the 33rd floor, where he fired multiple rounds before turning the gun on himself. He was identified as a Las Vegas resident who had traveled cross-country before arriving in New York City. Papers found on the shooter's body indicate he had grievances with the National Football League and its handling of CTE. That's what officials told CNN. In a memo to staff, NFL Commissioner Roger Goodell confirmed an NFL employee was, quote, seriously injured and is currently stable in the hospital. We'll continue to bring you updates on this story throughout the day. And now let's turn to our top stories of the day. Futures higher after the S&P 500 notched its 15th record close of the year, and the busiest week of second quarter earnings season ramping up. Plus, the Fed expected to hold rates steady as it kicks off its July meeting. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, senior markets reporter Josh Schaefer here in NYC, and Fed correspondent Jennifer Schonberger. So as we are looking at the sort of record after record after record that we have been hitting here, Brooke, what have we been seeing in terms of commentary?
Yeah, in terms of commentary, is what analysts, strategists expect is that we need to hold on to this momentum in order to sustain these record highs. And that will come into play as we hear from big tech like Meta, Apple, Microsoft, as well as Amazon this week. They need to beat earnings and they need to show a positive guidance, a positive outlook on the second half of these years as AI takes place, as tariffs go into effect. And what we're really hearing is that in addition to that, we also have the jobs report out on Friday. We want to hear that jobs were added. We want to see that unemployment rate stay steady. And that's what really could hold on and lead to this ongoing momentum that we've seen in the markets, once again, leading to those record highs over these past few weeks.
And Josh, what do you think, where is sort of the market's attention focused here? It seems like it is mostly on earnings at this point.
Yeah, Julie, definitely. I mean, the Fed meeting's starting today, right? But of course, you won't really get a lot of news there until probably Chair Powell's press conference at 2:30. And then even just thinking about kind of the rally that we've had over the last 3 months and what's been driving the market. I mean, yes, there's been some volatility around specifically President Trump commenting on interest rates and commenting on Chair Powell's position. But there hasn't been a lot of real debate about necessarily when the Fed will be cutting in terms of the investor story, right? I don't think that's really been driving the markets throughout this rally. We've had moments where markets were pricing in more interest rate cuts this year and the stocks have been rising, and moments where markets have been pricing in less interest rate cuts and stocks have been rising. I recently polled 35 economists and strategists for the most important chart right now for investors, and one of them sent me a chart that relates to the Fed. So it's a broad question. They can answer with anything, and I sort of took out of that if only one of them, when usually 5 or 10 are talking about interest rates or the Fed. Perhaps maybe that's just not the key market driver right now. When you think about what's been leading the market higher, it's been tech again. You have tech earnings this week, a wide swath of tech earnings over the next 2 weeks beyond just mega caps. that seems to perhaps be more important right now as earnings have been leading in that sector. Do they continue to lead, and do you continue to see growth there? Seems to be a key question among strategists.
Yeah, so we're going to get to Jen on the Fed in just a minute, but I do want to linger on earnings for just a minute, guys, because we have some big names out this morning. And Brooke, I know that you're following Proctor and Gamble closely here, as we also, of course, are waiting those big tech earnings. But the driver, for the moment at least, is some of these other companies. So what do we hear from P&G?
Yeah, Procter & Gamble out this morning beating Wall Street's expectations, but largely what we really care about, what investors are really looking out for, is this $1 billion hit from tariffs. Taking a closer look at some key takeaways, what we heard was that their grooming and healthcare business is under pressure. Largely, that's something that we've seen consumers sort of take a pause, think, where exactly do I want to spend my money? They said that appliance volume declined. They also said that because of a lower average incidence of cough and cold in North America, consumers weren't jumping and buying those cough medicine. But once again, that outlook includes a $1 billion hit from tariffs. The company and at large, in addition to P&G, many retail forward consumer facing companies have said that they've looked to mitigate costs, but P&G saying that they're going to have to slightly raise prices mid-single digits in 2026 because of tariffs, as well as innovation. Innovation really a key driver here to get consumers to buy. In addition to that, we're also seeing a bit of unfolding of how exactly they plan to lean into innovation and commercialization. They're saying here that they plan to cut 7,000 jobs by the end of fiscal 2027. And something to look out for. We've seen so much C-suite change-ups, and that's something else coming to P&G. We know that Shailesh Jejurikar is set to become CEO on January 1st, 2026. The current CEO is stepping down, but largely this is a CEO that's really been the new CEO has really been running on supply chain. He's been running on innovation. And that's exactly what these companies need right now. They need an executive who will be front and center to really deal with all this, differences, these changes with tariffs going into play now.
Yeah, and Josh, I know you're keeping an eye on some of the other earnings this morning. We got Boeing, for example, and maybe things turning a little bit of a corner there.
We've been waiting for the turnaround at Boeing, it feels like, for a little while now, right, Julie? But yeah, shares popping a little bit over 1%, almost 2% now in pre-market. And their executives did point out that they do think in the release, they called it a, quote, turnaround year. And maybe that's starting to be what's forming here. But largely, when you look at results from a company like Boeing, better than feared is a word that often comes to mind. So Boeing's cash burn for the quarter coming in at $200 million. That was significantly less than the massive $2.3 billion they had last quarter of cash burn. Going back to the same quarter last year, it was $4.3 billion. So Boeing losing less money, revenue coming in higher than expected at $22.7 billion, slightly higher than expected, but again, a 35% jump from a year ago. And so really you're just waiting to start to see this turnaround story continue to form here. Stock had been up over 30% to start the year. So investors have been starting to maybe see that turnaround building a little bit, and we'll see how it continues throughout the year. But this, of course, Julie, a company we watch closely, is it is a Dow component. And as we talk about records, one index that we've been waiting to see get a record close in 2025 has been the Dow Jones Industrial Average, which has sort of been hovering near there, but I don't think we've actually gotten that record close yet as the NASDAQ and S&P 500.
Right, exactly. So we'll be watching that closely, and we're going to talk about another Dow component in a few moments, but we have to turn to the Fed, right? Because even if no change is expected, obviously, Jen, the Fed is under a microscope right now. But as many Fed watchers have been reminding us on this program, the Fed is not one person, right? The Fed is a whole committee. And so what could that sort of look like, the debate within the room? Not that we're going to know that today necessarily, the sort of color of it, but still, what can we expect?
Yeah, lots to pick apart there, Julie. As you said, the Fed widely expected to hold rates steady Wednesday afternoon as the majority of the committee favors a wait-and-see mode to see if tariffs are indeed impacting inflation as we go through the summer months, likely to spark further ire from the president, who's been hammering the central bank. But I am watching closely to see if we see two dissents from two different Federal Reserve governors. Those are Chris Waller and Michelle Bowman. Ahead of this meeting, Waller clearly said he was in favor of cutting rates. He thinks that any inflation that we would see from tariffs would be a one-time increase in pricing, and that would be something that the Fed could look through. He's also concerned that private sector job growth is stalling. Now, Bowman, on the other hand, had mentioned in June that inflation has come in benign And if it continues to come in benign, that she would support a rate cut. The last inflation report may be a bit of a gray area there, as we are starting to see some tariffs come through on the good side of the equation. Those services looking okay right now, though Bowman also saying she's more concerned about the employment side of the dual mandate. If we were to see two dissents from these two Fed governors tomorrow, Julie, that would mark the first time since December 1993.
Wow. So not common, to say the least. Just quickly, Jen, there had been a lawsuit that was trying to force live streaming of the Fed meeting. What happened with that?
Right. Well, hedge fund Azuria, which is run by James Fishback, who was close to the White House, had sued the Federal Reserve under the grounds that it was violating the Sunshine Act of 1976. Under that act, basically says that all federal agencies need to keep their meetings open. During an emergency hearing yesterday in federal court here in Washington, the judge denied that, saying that the Fed is not technically, or the FOMC is not technically an agency. It's part of a larger Federal Reserve system. And so the Sunshine Act doesn't apply here, though this is probably not the last we are going to hear from Fishback and his hedge fund Azuria on this issue. He says that the Fed is trying to skirt this by essentially having a joint meeting between the Federal Reserve Board of Governors and the FOMC. So we will see how this continues to play out in the court system. But today we will see another closed door meeting. It will not be live streamed.
As is typical, yes. Brooke, Josh, Jennifer, thank you so much. United Healthcare shares falling pre-market after the insurance giant said higher medical costs will weigh on its full year 2025 earnings. Here with more details, Yahoo Finance senior health reporter Anjali Kamlani. This is the Dow component I was referring to, by the way. And higher medical costs were expected. How did they come out?
Yeah, we know that we've seen this trend for the last year. And of course, you mentioned United Health being part of that Dow. We reported last quarter that it dragged the Dow down, and 88% of the Dow's decline had been attributed to United Health alone. That trend continuing. We've seen larger entities like CVS last year, Centene most recently. And the number to focus on for that is going to be the medical loss ratio. And we'll get to that in a second. But let's take a look at the numbers right now. Missing on the bottom line, but just barely beating on the top line is what we got from United this morning. And that's for the entire operational look. And we know that with the $111 billion in revenue, that is a key number that we're going to continue to watch, because while those revenues do continue to grow, the margin has decreased, and that medical loss ratio, as I mentioned, is one of the numbers that we're keeping an eye on. And what that means is when the premiums that come in and the ratio of what gets paid out is the key difference there. So this quarter, they just touched on 89.4%, and that is the highest ever that they have recorded in history, beating out last year's full year at 85.5. They're looking at keeping in that 89% range for the entire rest of the year. Now, this is less than numbers that we saw from the likes of Centene, which reported about 93%, but this is the higher end of what we've ever seen. Typically, that sweet spot is between 80 to 85%. So as you can see, well past that, and that number, by the way, set by the Affordable Care Act. So just to keep an eye on that as well. We also know that this morning we've heard a lot of commentary from the likes of the CEO, new CEO, Stephen Hemsley, who's a return. And even after 2 months in the seat, the tone has been damage control. Essentially, we've seen that comments from the leadership has been focused entirely around what the company is going to be looking to do. We also know that with the cost pressures, they indicated that 70% of all the pressure on this firm right now is Medicare related, physician related, and outpatient related. So going back to what those specific costs are and where they're coming from, Julie, that's what we're taking a look at.
Well, I was going to say there's another big healthcare story this morning, but there are a lot of big healthcare stories this morning. You've been very busy. But let's talk about Novo Nordisk, which is again cutting its forecast. Yeah, it is cutting its forecast. We have seen this be sort of a stock to watch for investors, because it is not the same story as its competitor Eli Lilly. We know that the two GLP-1 heavyweights are now under the microscope to see how they differentiate and continue to maintain their leads, considering what we know to be a very
very dynamic and very large market potential for them. Novo Nordisk cutting from 13 to 21% growth to 8 to 14%. So quite a big jump there, as you can see on your screen. That is really setting expectations for what we anticipate to hear from their earnings on August 6th. We also know they did also name a new CEO. Part of all of this story has been a surprising ousting of prior CEO Lars Jorgensen, and then they have a new CEO in place and quite a number of new management positions. So we'll be getting all those details and get the introduction to them when they do their earnings call. But I am also going to be listening to their call later today, so we'll have more details then.
Looking forward to it. I know you're going to have a busy day. Thanks so much, Anj. Also in the 11 a.m. hour, we'll be speaking with AstraZeneca's chief financial officer about that company's earnings. Speaking of busyness. Well, an $85 billion deal in the rail sector. Union Pacific agreed to acquire Norfolk Southern in a cash and stock transaction that will form a transcontinental rail giant in what stands to be the industry's largest deal ever. With a total enterprise value of $85 billion for Norfolk, it is the largest deal of the year announced so far as well, according to data compiled by Bloomberg. The deal comes a year after dramatic activist fight at Norfolk Southern and a subsequent ouster of its CEO. It narrowly fended off investor Ancora, which won 3 board seats. The deal raises competitive pressure on rivals, including CSX and Berkshire Hathaway's BNSF, to potentially pursue deals of their own to keep pace. Historically, rail mergers have been difficult to do, but the industry is hopeful that the Trump administration will be friendlier to industry consolidation. Coming up, we'll count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Baker Hughes, UPS, and SoFi. First up, Baker Hughes announcing it'll acquire cryogenic equipment maker Chart Industries in a $13.6 billion deal. That is the latest consolidation in the oilfield services sector as companies look to expand product offerings and geographic reach. As a result of the deal, Chart canceled its merger with machinery supplier Flowserve. The Financial Times reported early Tuesday that Baker Hughes had prepared to counter an offer to Flowserve's terms. Next, UPS declined to provide full-year revenue or profit guidance after reporting mixed quarterly results. Package revenue was better than expected during the second quarter, though adjusted earnings narrowly missed estimates. The company cited macroeconomic uncertainty in its decision to withhold forecasts. The company has struggled in recent quarters to recapture the volume it saw during the heyday of the pandemic. To solve some of its woes, UPS announced plans back in January to cut its Amazon business by more than half by 2026. And SoFi boosting its full-year guidance for the second quarter in a row after a solid earnings print. Revenue surged 44% from a year prior, marking the company's highest growth rate in more than 2 years. SoFi also added a record 850,000 new members in the quarter. The company has grown far beyond its origins as a student loan financing business, but its lending segment remains strong, especially in home loans during the second quarter, which rose 92%. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, stocks closed at yet another record on Monday, making for the 15th all-time high for the S&P 500 in 2025. With stocks at this level, should investors be concerned about markets getting frothy, about extended valuations? I want to bring in Youngyu Ma, PNC Asset Management Group Chief Investment Strategist. It's great to see you. So this has been an ongoing question, right? Because we keep seeing markets hit highs and we keep seeing the price to earnings ratio move higher for the S&P 500. Do you think we are in a sort of frothy period here?
Thanks, Julie. It's great to be here. I think we have to distinguish between pockets of speculation and outright excessive market froth. I don't think we have excessive market froth here. Yes, you can point to individual pockets of speculation, which is natural actually after 2 years of strong gains in 2023, 2024, right now where we are in the S&P 500 hitting new highs. You're going to see some pockets of speculation, but it's really not until you see sort of rampant excessive froth across the board that you should really be concerned that markets have just gone too far and priced in too much. I don't think we're at that point. I don't even think we're close to that point for that matter.
Youngyu, just for reference, what would that look like? What signals would you be looking for?
Yeah, there are a few big ones. Investor sentiment right now is just not, it's actually pretty neutral. If you look at some of the survey measures of investor sentiment that during times of froth tend to stay high, even during pullbacks tend to stay high, you're seeing them read pretty neutral these days. The IPO market is just getting back to what I would say is a normal, healthy level rather than sort of a booming IPO market where you're just getting a flood of companies coming to the market and massive first day gains across the board. That's really some signs that you would see of froth really taking hold across the market. I think you might see some meme stocks as we're seeing now being speculative, but that doesn't mean there's across the board froth that's in the market right now.
Gotcha. So in terms of what is driving markets higher that might be sort of more fundamental here, is it as simple as earnings, that we continue to see earnings come in perhaps better than feared and we're seeing that fundamental strength, the consumer keeps spending, et cetera?
I think earnings are part of it. Inflation is part of it. I think there's a belief in the marketplace right now that inflation will be transitory and that the Fed will cut rates. Not this week, of course, but later in the year, the Fed will begin a new rate cutting campaign. And of course, tech and AI and the strength of that and the spending that goes into that are just very strong drivers. And there's a lot of momentum that doesn't look like it's going to be slowed down anytime soon. So I think really those drivers, when you put that together in the context of a macroeconomic environment, we look 6 months out, we're getting interest rate cuts, we're getting stimulus from the fiscal spending or the fiscal budget bill. And you have an environment where those drivers that are in place can really remain strong and have some more tailwinds with the Fed cutting rates. I think that's what the market is keying off of right here.
And Young-Yu, as you know, busy week for large cap tech earnings. And it sounds like you still are in favor of that sector as well. Do you worry at all about, sometimes folks worry about a so-called crowded trade, right? Because I think almost everybody I've talked to still likes this group.
Yeah, when does a trade get crowded? That's an interesting question. I think that, for everyone, when we're looking at what's going to be driving the economy forward, both the US economy, the global economy, it's going to be technology. Technology is becoming an increasing part of our lives. People are using AI. It's becoming implemented both at the individual level and in corporations more. Technology is just becoming a greater part of everyone's life. I don't believe this is a crowded trade based on where the world economy is going in terms of incorporating more and more technology into our lives and into companies' usage.
The other group that I have found really interesting this year has been the industrials, where we have seen some outperformance at the same time that we've seen tech continue to do well. Is that a group that you think still has some momentum from here?
We do like industrials. Industrials are priced, I wouldn't say priced for perfection, but there's a lot of expectations currently priced into them. We do think those expectations will be met. We think that fiscal budget, that fiscal bill actually adds to some of the strength that industrials will see in the coming quarters because there is that stimulus from that 100% expensing of CapEx and R&D and greater ability to have tax incentives for debt and interest payments. So I think all of those do play into hand of industrials and just building out the base for electricity, building out the base for data centers, some of the reshoring that's going to take place. All of those do favor industrial. So we think there's still a lot of momentum. We don't think we're in the late innings of industrial strength. We're probably in the middle innings right now, though.
Interesting. Young-Yu, thanks so much. Good to see you.
Thank you, Julie.
Coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sozzi, is joining us now. Brian, what are you focused on today?
Julie, I was so excited coming into this week about earnings. Things were going pretty well. Sales were beating, earnings were beating, things were good. Markets were at records. But I got to say, Julie, the earnings out this morning largely stunk. I mean, Whirlpool warning about how it may have cut its dividend because of tariffs. Stanley Black & Decker warning about an $800 million profit because of tariffs. Proctor and Gamble warning about tariffs. So it has been a tariff fueled morning, and it really makes me question why the market is trading at these levels.
Yeah, the market doesn't care about tariffs, Saz.
Well, maybe it should, Julie. Maybe it should.
Wow, staking a claim there. All right, thanks so much, Saz. Much more ahead on Yahoo Finance.